All right, let's get right into it. We're going to tackle a topic that's a huge part of German financial planning, but honestly, it can be super confusing. I'm talking about life insurance. Is it still a smart move, or is it kind of a relic from a different era? Let's dive in and figure out a clear strategic guide for today's world. So, this is really the big question, isn't it? For generations, life insurance was just something you did. It was a core part of saving for your family's future. But now, we live in a world with rock-bottom interest rates and so many other ways to invest. Does that old logic even make sense anymore? That's what we're here to break down. Okay, so first up, we're looking at what I'm calling a promise on trial. Why? Because the very thing German life insurance was built on, that promise of absolute, rock-solid security, is being seriously put to the test by the way our economy works today. And here's where it gets tricky. You've got this fundamental tension. On one hand, everyone wants that guaranteed safety, right? But for the insurance companies, providing that guarantee is now incredibly expensive. They're stuck paying out on old promises while earning next to nothing on safe investments. Then, on the other hand, if you want any real growth, you have to take on market risk. It's this classic tug of war between feeling safe and actually getting ahead. So, how in the world did we end up here? Let's jump into our next section, the old guard versus new, to see how the whole economic game changed and how that reshaped the choices you have today. You know, the story of German life insurance is really the story of interest rates. If you look back to the 90s, rates were high, and it was easy for insurers to offer these amazing guaranteed returns. It was a no-brainer. But then, the music started to slow down. Rates just kept falling and falling, and then the European Central Bank basically took them to zero. All of a sudden, those old contracts became a massive headache for insurers. So what did they do? They created a whole new kind of product that puts all the investment risk squarely on you. And that shift created two totally different worlds. The old promise was so simple and comforting. Guaranteed returns, long-term security, you could just set it and forget it. But the new reality? It's way more complicated. You've got almost no guarantees, your returns are tied to the stock market, and you've got to watch out for high fees. Suddenly, you have to think about the opportunity cost, what you're giving up by locking your money in one of these things. And that's a huge deal. Okay, so that's the world we're living in. What are your actual options? Let's walk through your menu of choices. But I want you to think about this less like a list and more like a toolkit. Each one of these is a different tool designed for a very specific job in your financial life. All right, first up, we have the purest and, frankly, the most logical form of insurance out there, term life. In German, Risikolebensversicherung. Its job is incredibly simple. Protect the people who depend on you. It pays out if you die within a set time frame. If you live past that, it just expires. It's not an investment. It is pure, simple, unadulterated protection. That's it. You see, the logic here is just beautiful. You're taking a massive, catastrophic financial risk, like leaving your family with a mortgage they can't pay, and you're turning it into a small, predictable monthly payment. It is the perfect tool for anyone with kids, a mortgage, or business loans. And its biggest limitation is also its biggest strength. It does one job, and it does it really, really well. Next, we've got the old-school German classic, the endowment policy, or Kapitallebensversicherung. Now, this is that hybrid product that tries to do two things at once. It mixes death protection with a savings plan. For decades, this was the absolute go-to for everyone. But here's the problem today. Its supposed benefits, like forcing you to save, are almost always wiped out by the downsides. In a low-interest world, the returns are so bad, they often don't even beat inflation. Think about that. Your money is actually losing its buying power every single year. The opportunity cost of having your money stuck in one of these instead of something else isn't just a small detail. It is enormous. Which, of course, brings us to the modern answer to that problem, the unit-linked policy, the Fondsgebundene Lebensversicherung. We'll call this one the grower. Instead of a measly guaranteed return, your money gets invested straight into market funds. The potential for growth is way, way higher, but so is the risk. So the trade-off here is crystal clear. On the plus side, you get to participate in the stock market's growth, and there can be some nice tax advantages. But, and this is a big but, there are zero guarantees. And you have to be so careful about the costs because they can be way higher than if you just went and invested in a low-cost ETF yourself. This really only makes sense for younger folks with a long time to invest and a stomach for risk. Okay, we've laid out the menu. Now for the most important part. How do you actually use this information to make a smart choice? let's get into the strategic rulebook for some simple, powerful rules to live by. All right, let's just boil all of this down. Rule number 1, and if you remember nothing else, remember this. Separate your protection from your investments. I'm going to say it again. Separate them. Use cheap term insurance to cover your risks and use low-cost things like ETFs to grow your money. Don't ever mix the two. After that, be smart about taxes, be absolutely obsessive about checking for hidden costs, and please, remember, this is risk management, not a plan to get rich. And that idea brings us to our final section. We need to stop thinking about just buying a product and start thinking about designing your financial architecture, a whole system for your financial security. So we have to completely reframe the question. We've got to stop asking which life insurance product is the best one. That's the wrong question. The right question is, which of these specific tools do I need, and what specific job does it need to do in my financial life? So what does that architecture actually look like? Well, think of it like building a house. Your foundation, the thing everything rests on, is pure protection, that cheap and simple term insurance to cover your debts and protect your family. Your pillars could be tax-advantaged pension plans, but only if they make sense for you. And your growth engine, the thing that actually builds your wealth, that's your portfolio of direct, low-cost investments like ETFs, kept totally separate from your insurance. Because at the end of the day, this whole thing isn't about buying some fuzzy, warm illusion of safety. It's about strategically using financial tools to build real, actual certainty in a world that is, completely uncertain. It's about knowing for a fact that your family is covered. That's what a smart strategy really gives you.